Hello and welcome to Masterclass with ET Now. My guest today is Mr. V Kamath, who is the chairman of Jio Financial Services. Mr. Kamath, thank you very much for joining us on ET Now. We are in uncertain times, and for the last 2-3 years, we are in a war mode. First it was Russia, Ukraine, and now the Middle East or West Asia crisis, which is there. How do you see India in this entire geopolitical crisis?
It's a very interesting time to be an observer of what's happening around us. Because on the one hand, I have been maintaining that we have a long runway, and Viksit Bharat is within our reach, as it were. And all indicators point to being able to achieve our objectives. And then you have unforeseen events hitting us at periodic intervals, sometimes with no, I would say, advance warning at all. COVID hit, and thereafter certain other events that happened 2-3 years back. And now this current situation that is, in a way, on us, on the entire world. We will have to navigate through all these things. But to me, the focus should be, and I'm sure will be, on the 2047 and the long runway that we have. That runway, none of these events can change.
And do you think India is positioned well to continue despite the distractions which are there from a geopolitical point of view?
Yeah, again, we need to look at fundamentals which we thought were in our favor and which would take us to the next phase of growth. And those, one was the runway. The second is we had cleaned up our balance sheets, the twin balance sheets, the banks and the borrowers. Most importantly, borrowers or the industrial scene in India had become competitive. They had, post-COVID, learned to be significantly more efficient than they were earlier, be globally competitive, and as a result, have cash accruals which are sufficient to meet growth, which never ever happened earlier. Companies always had to borrow. Sometimes it used to be 2-to-1 equity to debt to equity, 2 debt, 1 equity. But never ever less than 1.5:1 for any new project. And now you're in a situation the last 3 years or so where most corporates can meet their capital needs out of free cash accruals, or free cash generate. Now this is, I think, not fully appreciated by the people around us, that we as corporate India today can move on our own. We don't need necessarily external help. Of course, you will need funding for working capital and this and that. But by and large, this machine is now in auto mode. So that is not disturbed. So you have clean balance sheets, you have got, in a way, ability to implement projects in auto mode because your cash accruals are sufficient. You have side by side a very strong group of newcos. The newcos are the startups that have happened over the last, again, 4-5 years. Anybody's guess, 200,000 of them, several of them fintech, several of them in very many areas. I think all these provide the momentum for India, which you cannot say is true for many other countries.
If you look at the macroeconomic scenario, and we are well placed from a deficits point of view as well. Twin deficit we used to have 10-12 years back. Now it's well managed deficits which we have. Do you think that from a macroeconomic scenario we are much more agile in terms of adapting to these shocks which are coming either in form of crude or any other supply chain?
Yeah, I think you put it very well. Let me put it in context. Why? See, what I have observed, my stay in Southeast Asia during my time with the Asian Development Bank and thereafter with the BRICS Bank in China, analyzing large growth stories. There are a lot of small growth stories, but let me talk of 2 large. Take Japan, 1970 to 1990, maybe 20-25 years, grew at a rapid pace and transformed. At the beginning of the transformation, inflation was 8%, interest rate was 8%, and the yen to the dollar was 350.
Okay.
When things were in the steady state, early 90s, inflation and interest were 1% each, and the yen had come below 100, 93 or 94. Take China. So a lot of it happened when we could observe this more closely. Late 90s, the growth cycle started. Interest rate 8%, inflation 8%, and exchange rate was 8.5 to the dollar. I think China exited their growth, or their peak growth, 2015, 2016, just about the time I went to live in China. Exchange rate had corrected to 6.5, and inflation and interest rates were both down to around 2%, 1.5%, 2%. So what is the message that I got from this, or the learning that I got from this is, as countries transform and clean up their balance sheet, the country's balance sheet, clean up businesses and so on, these are the collateral benefits. Your interest rate, the authorities have more control on. Your inflation, certainly you have more control on. And then the exchange rate corrects itself. So in India, you have seen the first to happen. And to me, that is why these are not passing things, that you now have interest rate which is stable, inflation which is stable, what you mentioned at the beginning. It is part of the growth process, because we are now probably into, you take the COVID period as something of a challenge. We are probably into 7, 8 years or 8, 9 years of growth on a momentum basis. So I would think that as you go further, you will see all three, inflation, interest rates also tend down. And indeed, exchange rate also should tend down in course of time.
Mr. Kamath, we have seen a lot of shocks, global shocks, which have impacted economy, whether it's the South Asian crisis or the past West Asia crisis where oil shocks have come in. How do you see India positioned today as compared to maybe last 30 years or 40 years, where these shocks have had drastic effect on our economy?
That's a very good context setting that you have done. The key difference is that period, the earlier shocks, we were in economy which was still trying to get to be strong. So you mentioned the inflation was very high, interest rates very high, and exchange rate was not this position that we're talking. But the problem, as I see in those days, was bigger than all these three. We didn't have enough resources to do things which you wanted.
True.
So we did not have resources to build, whether it was a vast infrastructure or vast industrial bases, because where would the money come from? So government's kitty was limited, the government's ability to collect was limited, because the profit generation was limited. Today, all that has changed. So our ability to withstand this shock is far better than in the past, because India today is a much stronger economy than it was, say, 50, 60 years of its existence.
Do you think we are underestimating our own inherent strengths, and the way we have test ourselves during COVID, we are much more geared for any other kind of supply shocks?
Yeah. I would agree with that. I would agree with that for a reason. When COVID happened and when initial, I would say the fears were there, I did not expect that we would come back on our feet so quickly. Virtually in less than a year, from March to March 20 to March 21, we were back on our feet. And that showed a rare resilience and a willpower thereafter to clean balance sheets and run your business in a manner which will probably insulate you from other risks. That gives me confidence to say that, yes, today they are ready to face.
And that also forms the entire base for us for our runway to 2047 as well.
Absolutely. Without that, see, without clean balance sheets, clean corporate balance sheets, this game could not be played. We could not have played this game. And without, in a way, the government, the inflation coming down, and then the government having its ability to spend on infrastructure, certain infrastructure the government has to spend. And then, again, in other areas of infrastructure, to make sure that the revenue generation model is intact. Toll road is a good example. And the entire means by which you collect tolls is in place, so that becomes, in a way, self-financing. I think a lot has happened which at times we don't take cognizance when we say that we are geared to go along. So there's a whole lot of achievements that we build on.
The capital expenditure cycle that we have undertaken in the last 5 to 7 years, do you think that that has stood the time of ensuring that we have enough demand, internal demand coming in as a part, that of that cycle which there it's pushing more demand, and then and that's something which is rolling us forward despite what's happening it's like a bumpy road, but we're still going ahead.
Yeah, in fact, it's a virtuous cycle that has happened. In our case, infrastructure generally has lagged because we did not have enough to spend on infrastructure. Now we're getting into a situation where we have enough to spend on infrastructure. We can now invest in infrastructure as needed. We need not put it in too far ahead and hold idle assets. So we are putting in assets as needed, whether it is, and then we can actually tick off where we are now looking good and where we have to go. Ports, airports, I think we are looking good now. More can be built, there is no challenge. Roads, we started looking good, at least the highways. Now there is further opportunity because with the growth that is happening, the existing network will have to be strengthened. So I look at it as opportunity. Then you come to telephony. We are probably leaders in the world in terms of low-cost telephony and data usage. And then you come to public digital infrastructure. To me, that's an infrastructure. And that, again, for a country of our size, we're probably virtually along with the best in class. So a lot of things have happened which we don't give credit to or acknowledge. And if we do that, then it becomes clear that a lot has been achieved. And all that has been achieved, all these things, provide you the segue or the runway for the next 20 years or so.
We spoke about the public digital infrastructure and how beautifully it has aligned to banking and financial systems. Especially COVID was one of the triggers for us for that, how digital payments went. How do you see the banking system flowing here? There's a lot of changes which have happened, regulations have changed, ease of doing business has happened. Books are much more cleaner today as against what used to be there. But how do you see banking system or financial services system moving from here?
When you mentioned, I'll touch on another point for 30 seconds. You mentioned about digital infrastructure. Post-COVID, the food scheme that was put in place, and that continues,
yes,
I think was a game changer. As far as rural India was concerned, that was a game changer. So to me, there are a whole lot of building blocks which have been put in place, and they are there still. And they will, moving on to banking, I would probably look at it in a wider space, moving on to financial services. What is happening and what will probably happen? What is happening is visible. What will likely happen is we have to peep into the future. What has happened is the impact of digital public infrastructure and technological advancements. And these are advancements I'm talking for the 25-year period from 1996 to 2020. I'm still not coming to today. I'll come to that as a separate piece. The first 25 years or so, actually we could do a lot because we did not have to go the mainframe way. So the simple reason, we could not afford a mainframe. At the time, say, ICICI started transforming. But by the 90s, everybody had decided that the way to go is, smaller machines, digital distribution, and so on. Then came cloud. So slowly people went on to the cloud. This is by the late 2009s, early 2010s. Then came open source. Well, some of them adopted. I'm talking of the entire financial services space, the big guys at this point in time. And then around mid-2010s, 2014-15, along with the start of Aadhaar and digital public infrastructure, access to open source became more, I would say, prevalent. And that's where you see the burst in fintechs and digitechs coming up. They could now build on their own. They could take 30, 40, 50 IT professionals and build on their own. And most of them built on their own. They did not have to get anything from there. Now, the question to ask is, have the legacy players embraced that? I don't think they have. So we'll keep that aside for a moment. Then came the next layer of SaaS-based models, which again eliminated your task of using open source and building. Somebody was already building it for you. You have to now use it. There again, reason could be that the legacy platforms are too deep and too complex for people to play around with. So legacy players, by and large, have, in a sense, yet to go beyond cloud. And there's slow transformation going on. Whereas the new course which came on, the fintechs that came on, or the digitechs that came on post-2015, they're all native in terms of these technologies, and they have gone in. So today, I would think, of course, the regulator has to keep in mind the system, I would say, the stability of the system, and allow new players and not allow new players. So in a way, the existing players have got that advantage. I call it a moat provided by regulatory forces. So they are operating within that moat. The question is, will it last forever, or will incumbents be able to challenge it? Now, if you look at the financial services scape, and that's why I said in the beginning, not banking, I'll talk finance. See, the moat that incumbents had for maybe 15, 20 years in the broking business, online broking business, in one quarter it was destroyed. The COVID 1 or 2 quarters, whoever was the incumbent leader was pushed down to second or third position, and new companies came in. I would think that, to me, is the story that every financial sector company needs to look at. So tomorrow, what will it take for a startup to come and disturb my playing conditions? I believe first was broking. The next one in today's world is going to be the asset managers. Because this business is a technology business today. Because your models which allow you how to construct a portfolio, to the entire reach, leveraging digital public infrastructure and other ways in which you could reach your customers. So that becomes, so I would think that would be the second one. So 2 key pillars go. And in India, if you look at it, the asset management business, the rate of growth outstrips the bank's rate of growth in terms of deposits.
And banks are crying for that.
So you can now see the shift that is happening. Then come the 2 insurance companies, types of insurance, 2 or more. In our case, we call them general and life, but they could have many other pieces. So these also, I think, increasingly will be technology-driven and based on technology. See, when you are able to perfect the information that goes to your customer, you can disrupt a lot of things. So I think that stage we are coming into. So I expect a whole lot of change to happen there. And probably banks will be at one end of the spectrum because that area is driven by deposits. And rightly so, the regulator has to make sure that those deposits are protected. So the moat may continue for some time. But in, say, the trading business, not speculative trading, but the stock market business, there are no barriers. Similarly, AMC, there are no barriers.
Do you think AMCs are still hanging on to that legacy structures?
See, clearly, because the whole model was designed and built in the early 2000s, and I was part of it. It was built at a time you were capital scarce, you did not maybe know the business fully, and you did not have outlets. So you use a particular model. So for example, we used the DSA model at the time. We pioneered that model. Now, if today you stick on to that and that's your way in which you will distribute products, and in parallel you have got the ability to read the customer directly, the customer is getting savvier and savvier and younger. So the disruption then happens at a record pace. So I think we are in that zone, which to me appears could quickly change playing conditions for a lot of people in the marketplace.
Do you see